Hi, I'm Jason Scott. I'm a mortgage broker with TMG, the mortgage group in Edmonton. And we've been seeing interest rates fall pretty consistently over the last couple of months. There's a couple of reasons for that. Largely, it's driven by the sense that the economy is slowing. Now, economists and the governor of the Bank of Canada, they're always looking in the rear view mirror, trying to figure out where we're headed from an economic standpoint. It's obviously a really hard job to try to predict the future based on where you've been. The long and the short of it is, it seems the economy is slowing down. Inflation has definitely come back down to normal levels, although the price of everything is still way higher than it used to be. But the impact is we're seeing mortgage rates drop. Fixed rates have come down considerably, and a typical fixed rate right now might be around, say, 4.5%, plus or minus a little bit, right? And so the question becomes, how does that compare to a variable rate and where a variable is headed? A variable rate right now might be just over 5.5%. And that's a heck of a difference between those two rates. So which one should you go with? Well, if you believe the economy is going to slow down dramatically and that there will be future rate cuts by the Bank of Canada that will close the gap and pass where the fixed rates are, then you should go variable. Because if you do go variable, you can always lock into a fixed rate later. It doesn't cost you anything. The only requirement is that you have to lock in for at least as long as is remaining in your term. So as an example, you're in a 5-year term and you decide to lock in after the second anniversary, right? You have to lock in for at least 3 years, but you could also do a 4-year term or a 5-year term, etc. The other way you could potentially play it is you want the immediate savings, so you go with the lower fixed rate. Some lenders will allow you to do what's called an early renewal. So a year from now, you decide to lock in for an additional 5-year term, as an example. You're going to have a payout penalty in that scenario, but the lender will work that penalty into your new rate. So it's a way of driving rates down over time and potentially saving money and not exposing yourself to rates going the other way if suddenly the economy surprises to the upside. In terms of going variable and locking in, that can become tricky because you're trying to time the market. Lenders typically will not give you their very best rates at lock-in. So it really depends on who the lender is, how comfortable you are with payment changes, and more importantly, starting off at that higher interest rate. For your specific situation and specific advice for you, please give me a call, 780-720-2490.